But good morning. Thanks. Good morning, everyone. Thank you for having me. I've been part of Founders Bay for a good, I want to say 5 months now, since I started my own journey on this being providing accounting and strategic finance services. And it's been a phenomenal space to connect with other founders, funders, and also other service providers. It's a great community. So if you're not part of it, I would highly recommend you join it. You get a lot of inside access as well. I've done this presentation once before. We did it back in early January. We had some good response with people just understanding the basics. We're going to go through some basic stuff. We only have 45 minutes set aside for this. But the goal is kind of just to give you an overview of what do valuations look like? How do you look at your cap table? What are the different types of funding options out there? And then also like kind of bringing it together to say what funding strategy makes sense for you, what stage of your journey you're on, or where, like how much money do you need? What are you trying to do? What's your go-to-market happening? All of that kind of coming together and then choosing what your funding strategy is. And then we'll kind of close it off with financial projections, like how can it kind of come in and help you with this raising your next round of funding. And like I said, please ask questions as we're going. Sorry, am I echoing? Sorry, am I echoing for everyone, or is it just me?
You weren't before, but it just started echoing.
Yeah. Which is strange. I haven't done anything.
You may want to mute Neha.
Yeah.
Whoever the meeting host is.
Well, I think I'm the meeting host, but now it's gone away. So let's see if it doesn't do it.
It's stopped now. Yeah, it's stopped.
Which is kind of bizarre. Okay, anyway, so the first step, most of the valuation. So how do, like, when I started this, my question was like, how do VCs know like how much money to give you and how much equity would they get in return? So there's some basic things that they look at, and main is like there's a ton of metrics out there that they look at in order to make sense of how much your business is worth, how much should they be getting at that point. So the biggest ones, the most common ones out there are really ARR, MRR, and your user growth. These are really critical benchmarks. Now, with AI coming in, maybe these metrics might change a bit because there's companies that are kind of getting away from SaaS. They're doing more project or result-based revenue earning. So let's see how these metrics kind of change. But right now, the main ones are your annual recurring revenue, your monthly recurring revenue, and how your user growth is kind of happening month over month or quarter over quarter. They'll also look at your market size. You're probably all familiar with the TAM, SAM, and SOM. Again, be reasonable. A lot of founders, when they start the presentations, they'll start with this massive billion-dollar opportunity because they start with this TAM. It looks nice, it looks great, but really its SOM is really what your main target is. That's really what you can kind of go get with the stage your business is at. That's the most relevant metric to kind of focus on in those three. So if you have a presentation or deck, you're going to VCs and you're talking about these three things, I would not put a lot of time and effort into your TAM and SAM, like focus more on your SOM side, which kind of shows what can you actually get, what's more practical, what's more realistic. And the one I actually kind of always debate if I should move team and vision to the top of the slide, because this is really what's going to make you successful or not, finding the right founding team, finding people who understand what you're doing and are fully committed to getting that there. That's going to make or break your idea. There's tons of great ideas out there, but where it kind of falls apart is the execution. And the right team is going to help you with that execution. And we'll talk about how this team kind of plays into your cap table on the next few slides, so you can attract the right team and go with the right value when you go to raise money. Then the other things that they'll look at is probably like comparable companies. Is somebody else doing something similar to you out there? What has their success been? What has their outreach been? And how are you doing things differently that sets you apart from them? And then obviously the last one is they will kind of look at your future projections. Now, again, for a seed stage company, your future projections are really fluff. Like you're basing not on realistic things. You're basing it on your gut. You're basing it on the industry out there. You're basing it on a lot of other factors, but they're not real yet because you haven't actually gone and done it. You don't know the results yet, unless you're going and raising money when you already have some revenue under your belt. Then you have something you can kind of rely on and say, look, we've done it. this is what we can get. And so if we get this much money, we can kind of drive a lot more, and our projections, we can kind of show with comfort, comfort what it needs to be in the next 6 months or 12 months. Again, I'm going to just, I think most of you kind of know these metrics, just high level. The key metrics that we talk about is, like I said, ARR, MRR. Typically, early stage startups will be anywhere from 8 to 12x ARR is your valuation. And again, every company is unique. There's some great AI companies whose valuations are much higher than this. You could be on the lower end of it, depending upon what you do, what VC you're working with. Tons of factors would impact it. A key important number for you is burn rate. How much cash are you using every month? And so how much do you need to fund for the next 12 months, next 18 months? One of the things that kind of changed in the market, in the startup market over the last, I would say 3 years, is previously, if you look at 2021, it was typically taking a company from 12 to maybe 18 months to go raise a round. Between the rounds, there was 12 to 18 months. And once you decide, okay, I'm going to go raise a round, it would take you another maybe 6 to 9 months to actually close the round. Those windows have gotten bigger. So the gap between rounds is now kind of gone up to 18 to maybe 30 some months, 30, and then also the time once you decide, okay, I'm going to go raise money, that window has also gotten bigger. So kind of keep your burn rate in mind as you're looking out. So don't just look at the next 12 months, look at your burn rate for the next 18 to 24 months, and then plan your fundraising accordingly to see when will you run out. So you don't have to make crazy decisions in order to make your money last longer, because your fundraising is getting delayed because of just the way the market is now, right? And then other important factors are CAC and your LTV. Your CAC is your customer acquisition cost. Measure it early on. A lot of younger stage, early stage startups think like, I don't really have anything realistic. What am I measuring? But you'll be surprised if, let's say your CAC today is, I'm going to make these numbers up. Let's say your CAC is $10,000. But in 3 months, you've dropped your CAC to $5,000. And then another 3 months, you drop it another $2,000. That's a great journey for you to kind of show, like, look, we are making meaningful changes, that we've kind of reduced our CAC over time. So a number that was not meaningful to begin with, that 10,000 was crazy high, it didn't make sense. But when you kind of put it together with the progress you've made, that number becomes really reasonable at that time, right? So if you have access, which you all have access to your numbers, pick up what your KPIs are and start measuring them early on. Just keep them there so you know what's happening. It helps you understand your business as well, really well. There are other types of valuation approaches that will happen. There's a compural method, which is, it'll just look at startups in the same space as you are and see what they're doing. There could be a DCF model where they basically, if you already have some revenue under your belt, then what they're going to do is they're basically going to project your future earnings and they're going to discount it. It's not that common anymore. I think it's really and then there's the VC method. That's basically, they're looking, a lot of VCs are more, they want to know what they can make at an exit, right? So if you're going to VC at seed stage, typically their funds are locked with you for 10 years. Like that's the typical space they're going to see. So they have to see what's going to happen at 10 years. Like my average is we will make 4x of our investment, or some companies are going to fail and we're only going to make maybe 1x or nothing. So VCs have their own waterfall schedules where they kind of look at their portfolio and see how they're investing their money. They plan out their exit. So that's also important. They'll factor that in as well as they're trying to value you. Last one, again, we've talked about the team. Make sure you have the right team when you go to these VCs or when you're looking to raise money. So it speaks to the quality of your startup and how it sets you apart. And this might be the only factor that sets you apart from another company that's doing exactly what you're doing, but you have an amazing team. And you're like, we can turn things around just because of the team we have right now, right? All right, next topic, we're going to move on to what's the cap table. So cap table, initially in the beginning, you're just going to have founders equity. Make sure when you issue shares to yourself, they're common shares. A lot of VCs will not like if you offered yourself preferred shares. preferred shares are something that the VCs want. So that kind of belongs to them. So you issue your common shares to your founders, your co-founders. Keep aside 10 to 20%, if not more, for your key employees at the beginning. And I'm saying like maybe your top 10 employees. And there's research around this to say, is it worth it when you bring in a founder or a co-founder or your first 5 key hires who's like who can make or break your business? Is it even worth it to give them a larger chunk of equity? Typically, equity would be like you'll give it 1 to 2% depending upon what stage, what's their skill set. But there's a case to be made. If you bring somebody super critical, should you be giving them 5 to 10%, right? So assess what makes sense for you. But in the beginning, recognize the fact that, oh, I have met founders who'd be like, I don't want to give away my equity. And I'm like, you don't have anything right now, right? The question that's being asked is, do you want to have a bigger piece of a smaller pie, or you want to have a smaller piece of a bigger pie? That's what you need to decide. So what can you do at the very beginning to really create that momentum around your startup that you're able to kind of raise your seed and maybe your Series A? And it's your key employees that are going to kind of help you with that. So like I said, make sure that you have an ESOP. That means if you go to raise money and you've not put an ESOP plan together, your VCs are going to ask you to do that before they come in and invest money in you. Because what happens is if you do it after they've invested money, you're diluting how much equity they have in your company. So you want to do this before you go raise rounds. And typically at every round when you go in, your VCs are going to look at how much you have remaining in your employee pool. Because if you're saying, I'm going to take this money, I'm going to hire 100 people, they're going to ask you a question, do you have enough equity to get 100 people? Because keep in mind, everybody who's coming at a startup is looking for options, is looking for equity. So make sure you have that equity set aside, assess and evaluate as you're using it. How do you need to raise it and plan around it? There's other things you can do, like for your dilution. We'll talk about safes. They're a great way to kind of delay your dilution. You could stagger rounds. Like, for example, when I was at my last company, Mind, when we raised our Series C, we were getting a lot more money from another VC, and we didn't want to do it. So we kind of staggered the rounds. We said, no, let's just do this. And then 3 months later, we raised another round at the same valuation as the last one. So which kind of helped us kind of manage our dilution at that point. So stagger your rounds. Again, this is something you won't typically see at your seed or Series A. This will happen more as you get to Series B and up. Voting rights, dual class shares. Again, when VCs come in, they'll get preferred shares. They'll typically get a board seat as well. Not at seed, but more at Series A and up. Standard vesting schedules out there, I would say don't try to be special and create your own vesting schedules. It complicates things. It complicates the accounting. It complicates things for the VCs when they're looking at it. Keep it as vanilla as possible. Standard as 4-year vesting with a 1-year cliff. Don't go around that. I've seen where companies have done RSAs, RSUs, and they'll give special options that vest within the 1 year. It just creates a lot of complexities and a lot of headaches for people, the accounting teams, and also the VCs when they're trying to evaluate you, because they're looking at all of this, how the equity is going over the next many years. Typical equity retention, equity across stages. At the beginning, obviously, you've got 100% of the ownership. You should be allocating some number to your ESOP plan in the future that you're going to give to your employees that are coming in.
And I talked with my sister.
Oh, sorry. Is there somebody speaking? I think.
To cash out from the business account, they will lose that 5% of it.
I think you need to
So
mute
I
everybody.
I don't know how. Let me see. I can't see everyone. Hold on. Let me see if I can
Can you
mute.
check your Western Union?
I think it's
account?
Dilaram
If there's
A,
like any promotion, because it applied promotion
where the audio is
online.
coming from.
Since I'm presenting, I'm not able to see all the
So we'll do that
presenters.
too.
Maybe it's gone. Okay, good. Perfect.
What do you say?
Oh, no, it's still there. Chris, are you
Hello?
able to see this?
Okay.
Okay. Seed funding, typically 10 to 25% of the company is going to go.
If you
You get
like
Oh my God.
Yeah,
Hold
$5,000.
on. I'm gonna stop presenting and see the
R-
founder.
Ramandeep, you're the host. You could
Yeah.
probably right click on Dilaram, right click
Yeah,
and then
that's what I'm
mute.
trying to do. As I'm presenting, I couldn't see the participant list. That's why. Hold on. It is okay. All right. She has been muted. Perfect. I'm gonna share again. All right, you guys can see my screen again?
Yes.
Okay, perfect. Again, please interrupt with any questions. If this is, you're like, we kind of already know this, we have more insight questions we'd like to know. I'm happy to speak from my experience and share those as well. Seed funding, 10 to 25% of the company. You keep 80%, investors get 20%. What I have not accounted for here is your ESOP, obviously. So maybe it's 10, 70, 20. As the dilution keeps happening, it's a simple math exercise, which you can kind of plug into anything, and you can kind of see how your dilution is going to happen over time as you're giving more and more of your equity to VCs who are coming in. Now, two things that we want to talk about. There's two types of funding you can get. There's the dilutive, which means the share or the shares that you own in the company are getting diluted as you bring in these people. And then there's the non-dilutive funding. There's pros and cons to both. You can get a lot more aggressive growth with dilutive funding because it's more intentional. You get a larger chunk of money. So you can do things faster and bigger. With non-dilutive funding, there's the balance is it's not going to get any equity. They usually grants, there's some kind of revenue-based financing, or it's just you putting your own money in and bootstrapping it. But it, like you have less money, that means it's slower growth, slower pace. And in today's age, there's so many startups out there. Everybody's moving fast. Everybody's trying to get to that finish line or raise their next round. You need to decide what's more important to you. Like, I want to raise a big chunk and just go guns blazing. Or no, I really believe in this idea. This is unique. I'm the one who can do it, and I'm going to bootstrap so I can hold as much as equity and value as I can until I need to go raise the next round. And then I can raise a lot higher valuation. That's why people try to bootstrap, is because they're trying to say, I want to get something to meaningful so I can get a higher valuation because I'm proving something. Versus in the beginning, if you don't have a lot to show, you're not going to get a higher valuation, and maybe you get less money and you give away more of the company. So see what makes sense for you, for your situation. A lot of experienced founders will come in and they'll bootstrap for a bit because they have the money to do so. But then they have the connections, and then they can go raise their next rounds, much bigger rounds. And that's really their goal, what they're trying to do. I think we've kind of talked about this seed round. I'll just give you some averages. Typical seed round, the average in the US, I want to say is $3.6 million for a seed round. This depends. I've seen some companies only raise 500. Also seen companies that have raised as much as like higher than 5 million for the initial seed round. So it depends, but that's the average. Now, this is very US and Bay Area specific. I've heard metrics like if you're trying to do your seed in Europe, the average there is 1.8 million. There is, yes, I didn't. So that's, I called it out. So the ESOP percentage in the previous slide, if you would look at this one, I would say this 80%, 20% is probably 70, 10, and 20. The investors get 20, your ESOP is 10%, and then your founders are 70%. So that math will kind of come into play there. Series A typical is again 5 to 20 million. I want to say the average is like 12 something for a Series A. This varies across industries. This varies across different markets, founders, so many metrics that kind of come into play here. Again, pros are you have a large chunk of money. You can go speed up your thing, speed up your hiring, have your go-to-market really refined, and you can go, you can bring that money to good use. Cons are obviously you're just giving away equity to your company. You're going to have people who are going to come on your board. You're going to have people who are going to give you pressure to meet these aggressive targets. You're now suddenly accountable to somebody, but you have to go present and show how you're doing on a quarterly basis. I think there was a question on the chat that came up. My view is really messy that I can't see the chats. I'm sorry. Let me see. No, so the founders are not vesting over 4 years. When you're founders, you're just gonna issue yourself common shares, so you vested day one. ESOP is only for your other people as you bring in into the company after your founders are already there. All right. All right, safe. This is a very thing that's become really hot over the last few years. Safe in its base means that a VC comes and gives you money, but they're saying, hey, we'll get equity in the future. And the reason it makes sense is when you're trying to raise money and you're giving equity to somebody, there's a lot more legal paperwork that's involved. There's a lot more due diligence that's involved. And it takes time and it takes effort and it takes money. So this is a way around it. So a company, maybe a VC that really believes in your ideas, like, hey, we'll just give you the money right now. It's not a loan because you don't have to pay it back. But what's going to happen is when you raise your round, the next round, when you're going to go do this money, it will convert into equity at that point. Now, if you don't put incentives around this, they will typically not want to do a safe with you. So a simple safes are not that popular. What are more popular is either a safe with a valuation cap, which basically says if you end up raising at a higher valuation, they're like, we don't want that. We want a guarantee that there's a cap to the valuation. So for example, let's say you went and raised money at a 10 million valuation, but in your safe, you'd put in, hey, you get it at the 5 million valuation. So that's their reason to give you the safe because they're getting a deal, right? That they are getting their equity at that point at a 5 million valuation, whereas the other investors who are coming in are getting money at a 10 million valuation. Same thing, there's a concept with a discount where you'll say, if we'll give you a certain discount on the valuation. So if other investors, VCs are giving us $10 per preferred share, you get a 20% discount and it'll be $8 for you. And then there's a combination of both. You can do a safe valuation cap and discount. So it's like whichever is more beneficial between the both of them, VC gets that. And then there's the last one. I won't spend a lot of time on it. It's called the post-money safe. That's something the Y Combinator came out. It's a bit more tricky, more confusing. So I haven't seen it in real life yet myself, so that's why I can't speak much to it. But you're more than welcome to go search on the post-money safe and see if that is something that makes sense. Now, typically, the VCs already have what they work with. So it's not like you'll come to them and say, how about a post-money safe? They'll be like, no, we don't do that. They already do certain types of safes, and that's what they're going to stick with because that's more comfortable for them. They know what it means, and it's faster and quicker for them to do that. So see what's the right safe type for you as you talk to the VCs. If they do the safes, understand from them which is the one that they prefer and what works for them. And they'll usually coach you and guide you through this as you're raising the safe. So this is a great way for you to kind of go in, raise the money. Like I said, it's not a loan. You don't have to pay it back. If it doesn't go anywhere, it's not like you owe anybody anything. It's just written off at that point, but it just converts to equity in the future. Just a high level compare. The angel investors will typically give you 25 to 500K. You have a high level of control. There's no board seats involved. It's literally pre-seed. You do get a lot of personalized mentorship and support. Now, I would encourage you, if you're really early stage, there's a ton of angel investors out there. There's Bay Area Angels. I bet you like Marianne and Chris can share a ton of these angel investors out there, and they offer a lot beyond than just the funding amount. Like this is really a way for you to get some kind of mentorship and support from that network. They will work on trying to give you the connections to the next VCs, so you are able to kind of raise their next round. So that's a great avenue if you can go find a good angel investor. Obviously, there's the VCs. They want a lot more control around it. They'll get a board seat typically. I don't know how much VCs give you as far as support. Like personally, like at my previous company, the only support we got from our VC was really like when we wanted to go raise our next round, they would make some connections, but there was no mentorship as part of it. So it's more they just give you money and then you run with it. The one thing I've not put in here is accelerator programs. There are a ton of good accelerator programs out there. And some of them do it without equity. Like I know Y Combinator will typically take 5 to 7% of your equity for you to be part of their accelerator program, but then you get the stamp that you're Y Combinators. I've met some VCs who say like, hey, we only invest in Y Combinator companies because they're like, somebody's already done the due diligence. We don't need to do that. So a lot of new and upcoming VCs who are starting with their own new first-time funds, they will restrict their investments to, they'll only have like a criteria, like if you're a Y Combinator or a Skydeck or Plug and Play or the Stanford Accelerator program, and if you have some revenue, that's the only way they look at you. So it's a great way for you to become a part of these type of accelerator programs. There's a ton, like I said, ton out there. Go look what makes sense for you. Not everybody takes equity. A lot of them, like I want to say Plug and Play doesn't take any equity. They want you to come into their program. They'll give you a lot of coaching and mentorship. I think it's an 8 to maybe 12-week program. And then they give you connections to the VCs. And that's when Plug and Play will come in with an investment. Like if they can attract enough VCs around you, they will get part of the investment at that time. That's their play on it. But yeah, go look for that and see what if you're able to get into one of those accelerator programs. And then a lot of large companies also do this, like AWS GenAI has its own, Cloudflare has its own, Oracle has its own. And their goal really to get them is to use their product. So like if you get with AWS, they don't give you money, but they give you a ton of like AWS credits that you can use. If you get an accelerator program with Oracle, they'll give you Oracle credits, which you can get to either get NetSuite or other Oracle products that you can use. And they'll give you mentorship and support with it. But the money doesn't really come in directly. The money is more in the form of some kind of credits for that company that you can use for your startup. Again, this is what we've talked about: bootstrapping, finding angel investors, venture capital, or any alternative methods where you can do grants, revenue-based financing, or any crowdfunding you can do. I've personally not come across any alternative methods, but there's a ton of these out there. So you could find somebody who helps you just run these. I bet you there are companies that can help you just get grants out there. So you can get in touch with them to see if that makes sense for you. That's usually like, good money that you can use for your business without giving any equity, without having to pay it back. Last one is really your financial projections. I would say make sure when you're going to VC, so you look polished, is have realistic forecasts. Don't show your company growing 10x every year for the next 5 years. Like you'll be like $1 billion company in 5 years. That's not realistic. That's not practical. So choose numbers that make sense. Look at industry standards out there. Go look at some benchmarks. Understand your business to see what makes sense and what doesn't make sense. Make sure you project your operational costs really well, right? Like don't just, if you're going to hire a full-time person, know that there's benefits and overhead that goes with it, which is typically 20 to 30%. So if you don't project that, you've missed your cost by 20 to 30% right away. So make sure when you do your operational costs, you're scaling and growing appropriately. It doesn't look like you've hired 10 people and suddenly next year you have 5 engineers. It'll be like, did you fire 5 engineers? Like what happened? So those numbers, your head count, all of that needs to kind of come together and tell a good story of how you're growing your business. Know where a break-even analysis is happening. Now, this wasn't a thing 3 years ago. Nobody cared about profitability for startups, They just wanted you to grow the top line, which was your revenue. But now VCs care about when you're going to be profitable. So be realistic about that. When do you think that's going to happen? And if you can get that sooner, just because you have a great growth strategy, you have a great revenue model, that's amazing. That would help you get that next round really well. And then show your growth metrics, like what's your acquisition look like? What does your churn rate look like? What does your other KPIs that you're focusing on, maybe your CAC? What do all of those look like and how it's balancing out? And then I would also say, make sure when you do your forecast for your own self, have 3 scenarios. I didn't put them on the slide. It's like your best case scenario, and it's your worst case scenario, and it's like an average scenario. Kind of have those 3 things together so you can really understand if you didn't get enough money, that's your worst case scenario. What does that look like? Or if you got a lot of money, that's your best case scenario. So you kind of understand your numbers really well. So make sure your projections are defensible. Don't just make up numbers. Have metrics behind it. So you have a really good understanding of what's happening with your business over the next 18 to 24 months. That's really it. I would say go find a good partner for yourself. If you're too early on, maybe you don't need somebody like that, but maybe as an advisor, talk to people, understand what makes sense for your business, lean on other people if you can, being part of communities like the Founders Pay right here, you can find other people who've probably done what you've done or who have some skill set that they can kind of offer you and help you tweak your story, your deck better, that can kind of just help you with the edge and get something better. That's really it. I will open it up for questions.